What is the one thing every business, from the local coffee shop to a global corporation, needs to survive day to day? It's not just long-term profits, it's working capital. So what is working capital? Working capital is the money a business uses for its day-to-day operations. It's calculated as the difference between a company's current asset and current liabilities accounts due within a year. It shows whether a company can meet its short-term obligations and operate smoothly. Working capital is calculated by simply subtract total current liabilities from total current assets. Current assets are things the business can quickly turn into cash, such as cash on hand, inventory, and money customers owe within 1 year of the balance sheet date. Current liabilities are the bills and payments that business must pay soon, like supplier bills, short-term loans, and rent. If current assets are higher than current liabilities, the business has positive working capital, meaning it can meet its daily obligations comfortably. If liabilities are higher, the business has negative working capital, which can lead to financial trouble. Why working capital matters? Working capital is important because it keeps the business running smoothly every single day. Even if a company is profitable, it can still struggle if it doesn't have enough cash to pay its short-term bills. Strong working capital allows a business to pay employees on time, buy inventory, cover rent, utilities, and daily expenses, handle unexpected costs, avoid taking unnecessary loans. Without enough working capital, the business risks delays, shortages, or even shutdown. Let's look at a simple example. Imagine you own a small shop selling drinks and snacks. Your current assets are $1,000 in cash, $700 in snacks and drinks as inventories. Customers owe you $300. Your current liabilities are $800 in supplier bills, $300 in utilities, and $200 short-term loans. After the calculation of working capital, you are left with $700. This means you have $700 left to keep your shop operating. This is healthy for a small business. It gives you enough space to buy more goods, pay your bills, and handle small emergencies. Now imagine your liabilities rise to $2,000 because of higher rent or increased supplier costs. Your working capital drops to zero. This creates problems. You can't restock products. You might delay payments. Customers may find empty shelves. Your sales drop. This shows how quickly poor working capital can harm a business, even if it is profitable. So how businesses improve their working capital? Businesses use several methods to keep working capital strong, like collect customer payments faster. Shorter payment deadlines increase available cash. Negotiate longer payment terms with suppliers. This gives more time to pay bills without pressure. Avoid overstocking. Too much inventory traps cash that could be used elsewhere. Use short-term financing wisely. Loans or credit lines can help during temporary shortages. These strategies help businesses stay stable and avoid cash flow problems. Lastly, working capital is the money a business uses every day. It shows whether the business can pay its short-term bills and continue operating smoothly. Healthy working capital means stability, flexibility, and the ability to grow. Poor working capital can lead to delays, shortages, and financial stress, even for profitable businesses.